Hello, it's Friday, the 25th of July. Generally, this week has been a quieter one in terms of news flow and most importantly, in terms of markets. They've been relatively becalmed. Equities have ground up and hit all-time highs again in the US and the UK. Indeed, this is the third or fourth consecutive all-time high in the US yesterday. And overall, bond markets haven't moved a huge amount. So it feels as though if people aren't already on holiday, they've at least got sort of one eye on the sun loungers. So a quiet week overall. The main drivers of markets this week, there's three main sources of news flow. The first one, tariffs and trade related. We've had some decent economic data out, and then we've had some company reportings as well. So we'll run through those. In terms of company reporting, generally it's sort of expectations haven't been fantastic, but generally we've had companies beating expectations. A couple of notable exceptions there in terms of Tesla sort of really sort of guiding people's expectations downwards, but generally things are sort of more or less in line or ahead of expectations there. On the trade side of things, a number of different angles to explore there. The first one and the main one is that it seems that a deal's been done between the US and the European Union with a tariff level of 15%. Represents a compromise from both sides because the US started at a higher level and the European Union started from the perspective that they wouldn't sort of accept any tariffs in certain areas. So a fair compromise, and the market has welcomed that overall. On another sort of trade-related point, there's been a free trade agreement between the UK and India, clearly sort of smaller in scale than a US and a European Union deal. But it's been 3 years in the making, apparently. But it's interesting to see perhaps the US's activity by sort of making trade stickier and more difficult elsewhere, perhaps to sort of catalyze that deal and sort of got it across the line quicker than it otherwise might have done. So again, interesting to see what the unexpected and unintended consequences of this sort of America First agenda might be. We're still very firmly in the foothills of that journey. It'll be interesting to see in the years to come how all of these various things pan out. In terms of economic activity, the data's been pretty solid this week. We've had purchasing managers indices around the world actually not looking too bad and sort of in expansionary territory, particularly on the services side. So, manufacturing, the creation of physical things, they're more likely to be subject to tariffs. It's a lot easier to sort of tariff a physical good than a service. So the picture there is not quite as positive. It's not bad, actually, all things considered. But on services side, you're seeing actually some decent positivity coming through there. Labor market in the US also looking pretty robust. We had inflation data out of Japan. It's the fifth consecutive monthly print of inflation, sitting above 3% year over year. That was sort of inconceivable a couple of years ago. And it's a good reminder how something that feels totally inexorable, like sort of deflation in Japan, which was firmly in place for a couple of decades, these things can change, and they can change quickly. It's wrong to assume these things continue in perpetuity. You've always got to look at the fundamentals and what's sitting behind these data to see if that could change in the future. We've had ECB rate decision this week. They didn't do anything which was broadly expected. It has been interpreted as a slightly sort of hawkish statement alongside it, really a sort of a wait and see approach again, underlining the point that there's still an understanding that tariffs and impingements of trade will be inflationary in the second half of this year. The ECB, Christine Lagarde, has a sort of wait and see approach, really sort of echoing comments we've had from a number of different central bankers around the world over the last few months on the subject of central bankers. Donald Trump seems to be sort of softening his position on Jay Powell slightly, doesn't seem desperate to oust him straight away, and also doesn't seem in that much of a rush to nominate his Federal Reserve president. There was some speculation he'd almost sort of create one in parallel in the short term. That seems to be less likely today, although if you saw the video of Donald Trump and Jay Powell at the Federal Reserve's construction and renovation project that came out this week, you see there's not a lot of love lost between those guys. So it's a tense and testy relationship, but it seems to be sort of working okay for now. The market response to all of this information has been a sort of broadly constructive one for equity markets. The interesting nuance perhaps is fixed income markets, where on the back of the European Central Bank's pronouncements yesterday, you had a degree of yield rising in Europe, relatively modest, 5, 6, 7, 8 basis point increase on a 10-year, but that represents a degree of selling off of that asset class. And we had a similar outcome in the US, a degree of yields drifting up on the basis of that stronger economic data, suggesting again there's less imperative for the Federal Reserve to cut interest rates as well. So slightly different reasoning behind those increases in yields, fairly small increases in yields, but again, a nice reminder of the different dynamics you should expect from equities and fixed income to normal market environments. Equities responding well to positive economic data, and it's less positive for fixed income because it means that there's a lower probability the rates will need to pull down sharply, and that's exactly what you want when building multi-asset portfolios. Overall, then, no real change in our market views over the short run. We remain sort of broadly constructive and diversified and differentiated in terms of how we position, and patient and disciplined in order to not be overwhelmed by short-term news flow, allow fundamentals really to come to the fore in the portfolios over the medium to long term. That's it from me. Have a good weekend when you get there, and we'll see you next time.